Hello, welcome to Fenlina School of Entrepreneurship. My name is Nathan from Fenlina Management Consultants. The lesson today is about business transactions and supporting documents. Let's start with the revision of the previous chapters that we did. Introduction to Accounting, Lesson 1 and 2. The following were explained clearly: the various definitions and classifications, fundamental assumptions in accounting, qualitative characteristics of financial accounting, dual concepts, content of various financial statements, and the accounting process. Relevant examples of each of the above were given to show how accounting principles apply in our day-to-day lives. Practice questions were given to enable everyone to follow the program. The importance of leadership and politics on accounting and entrepreneurship was briefly mentioned. If you like this video, please remember to subscribe, give a thumbs up, and make your comments known to us for a better level of service. In today's topic, we are going to look, as I've already mentioned, business transactions and their supporting documents. The business transactions that an entity performs involve the buying and selling of goods or rendering or receiving of services. These documents are kept by a bookkeeper as evidence of the source of the information that appears in the financial statements. Absence of supporting documents may lead to unfair presentation of financial statements. Auditors rely on the supporting documents to determine if the organization adheres to its policies and procedures. The information contained in the financial statements should be reliable based on the source documents. This chapter aims to achieve the following outcomes: further understanding of the double entry principle, that is, how each transaction is composed of the debit and credit sides, various applications of the accounting equation. In other words, the left-hand side is always equal to the right-hand side. Identification of the different types of business transactions and relating them to the accounting equation. For instance, how assets, liabilities, income, expenses, and equity are related. Understanding of the perpetual inventory system. In other words, how is inventory recorded in the double entry system? Whenever an entity buys or sells a good or renders a service in exchange for money or an item deemed to be of the same value, this is referred to as a business transaction. For instance, you go to a shop to buy a loaf of bread for $1. The first part of the transaction is the buying of the bread. The second part of the transaction is the payment for the bread. It can be vice versa. You can pay for the bread and then you get the bread. So there are two elements in these transactions. Another example is if you take a goat to a neighbor in exchange for a sheep. The first part of the transaction is the acceptance of the exchange. Then the second part of the transaction will be the actual exchange. Types of records of business transactions. Business transactions can either be cash or credit. We record them in the subsidiary journals. Buying cash is recorded in the cash payment journal, sometimes called CPJ. Selling cash is recorded in the cash receipts journal, abbreviated as CRJ. Buying on credit is recorded in the creditors journal, abbreviated as CJ. Selling on credit is recorded in the debtors journal, recorded as DJ. Returns inward, all sales returns, are recorded in the debtors allowance journal. Returns outwards, which are regarded as purchasers returns as well, are recorded in the creditors allowance journal. Other subsidiary journals that we use are for the petty cash transactions such as postage, cleaning, coffee and tea, and so on. Then we have the general journal, which records any transaction that falls out of the above subsidiary journals. Examples are non-cash drawings, interest charge on debtors' accounts, credit losses or bad debts to be written off, annual depreciation, credit loss allowance adjustments, credit loss or bad debt recoveries. The accounting equation is further explained. The following equations are essential as principles of the double entry and dual system. Total assets equals total liabilities. Assets equals owner's equity plus liabilities. Owner's equity equals assets minus liabilities. Owner's equity is also equal to capital plus profit minus drawings. Profit is income minus expenses. According to the principle of the double entry, there is a corresponding credit for each debit and vice versa. We are going to look at quite a number of these examples that relate to the accounting equation. In applying the accounting equation, we use the following questions as a guideline. 1. Which accounts are affected? Are they assets, owner's equity, or liabilities? 2. What type or types of accounts are involved? Is it an asset account, liability account, income account, or expense account? Number 3, does the transaction amount to an increase or a decrease? It is also important to note that all income and expense transactions will affect owner's equity because owner's equity is capital plus profits minus drawings, and profits itself is income minus expenses. In other words, the owner's equity is equal to capital minus drawings plus income minus expenses. How do we apply the accounting equation? We have example 2.1, which says indicate how the following transactions affect equity, assets, and liabilities. March the 1st, owner deposits 40,000 in the business bank account. On the 2nd, purchases office equipment from company A for $8,000 on credit. March the 3rd, purchases a vehicle and pays cash $13,000. 4th, owner withdraws $600 for personal use. 5, sells one of his vehicles on credit to company B for $2,500. 6th, obtains a long-term loan from the bank of $20,000. 7th, company B pays its debt of $2,500. 8th, pays the debt of $8,000 to company A. This is how the answer should look like. Owner's deposit of $40,000 in the business bank account. This amount goes into the bank account, therefore it increases the bank account. But it also increases the owner's equity because he's putting money into the bank. So it is increasing the bank account and also the owner's equity. Second, purchases office equipment from company A for $8,000. What does that mean? There is an asset which is being purchased, but there is also a liability who happens to be creditor A. Therefore, it increases the assets and increases the liabilities. Third, purchases a vehicle and pays cash of $13,000. This increases the asset vehicle, but also decreases the cash. In other words, now both of these transactions are assets. One is increasing, one is decreasing. You buy a vehicle, you are increasing your assets. You are paying cash, you are decreasing your asset of cash. Fourth, owner withdraws $600 for personal use. This reduces the owner's equity and also reduces the bank account. The sale of the vehicle is on credit. In other words, we are creating a debtor and also reducing the vehicles. So there is an increase of the debtors account, which is an asset, but then a decrease, another asset of vehicles. Obtains a long-term loan from the bank of 20,000 US dollars. This increases the loan account, which is a liability, and the bank account, which happens to be the asset. In other words, when he gets a long-term loan, it increases the bank account. But then, a creditor, who happens to be the bank, as our liability. Seventh, Company B pays its debt of 2,500 US dollars. This increases the asset cash and decreases the asset debtors. The company B is paying its debt. In other words, when he pays the debt, the amount increases by 2,500 in the bank account or in the cash account. But then there is a decrease in the asset debtors. So those two transactions are asset transactions. But one is increasing the asset cash, another one is increasing the asset debtors. Eighth, pays the debt of 8,000 to company A. This decreases the cash because we are paying the debt, and it also decreases the creditor, the liability, who happens to be company A. Whatever has been explained is summarized answer in the tabular format as we can see in our table. Example 2.2. This is more also about the application of the accounting equation. Indicate how the following income and expense transactions affect the accounting equation. March 1st, buys cleaning material from company C on credit of $500. March 2nd, pays allowances to personnel of $3,000. March 3rd, receives $25,000 from D for services rendered. 4th, pay electricity bill of $2,000. 5th, receives interest on investments from E of $4,000. How does the answer go? Buying cleaning material from company C on credit means there is no cash, but there is an increase in expense, meaning that our equity is decreasing because, remember, equity is capital plus profits minus drawings. So cleaning material reduces the profits, and therefore it is reducing equity. But then we are buying on credit, therefore we are increasing the creditor but decreasing the equity. In other words, cleaning material is an expense, it reduces equity. However, C is a creditor, an increase in the liability. March 2, pay allowances to personnel of $3,000. The allowances are expenses, they reduce the equity and the bank account. March 3rd, receives $25,000 from D for services rendered. Services rendered increases equity and the bank balance. However, if it is on credit, it will increase the debtors, which is also an asset. 4th, pays electricity bill of $2,000. Electricity is an expense, reduces equity and the bank balance, which is an asset. 5th, receives interest on investment from E of $4,000. This increases equity and bank account, which happens to be an asset. The above information is summarized in the following table. Summary of account categories. The equation that we always follow is that total assets, which are debit balances, equals total liabilities, which are credit balances. So in the table, under the non-current assets, we have land, buildings, display stands, equipment, vehicles, furniture. Under investments, we have fixed deposits. Under current assets, we have trading inventory, cash in bank, petty cash, debtors or trade receivables. And all these are equal to equity plus liabilities. In other words, under equity, we have owner's initial capital minus drawings, plus profits, which is income, minus expenses, then losses, which are debit balances. Also, we may have income and expenses. Under the liabilities, we have current liabilities and long-term liabilities. Bank overdraft is a current liability. Creditors or trade and other payables are current liabilities. Loan, which is shorter than 12 months, is also a current liability. Then long-term, we have the bank loan, which is more than 12 months. Bond on a property. Those are long-term liabilities. But like I said, the total assets will always be equal to the total liabilities, which happen to be equity plus liabilities. Don't get confused. Equity is part of liabilities because it has to be paid back to the owner. Accounting for inventory. There are two methods that are used to record and account for inventory: the periodic system and the perpetual inventory system. Perpetual inventory system goes as follows. When buying or purchasing inventory, we always debit the inventory account since it is an asset. Inventory can be bought cash or on credit. For credit purchases, we have to recognize and account for a creditor in our records. In other words, perpetual inventory system, on the other hand, will indicate that when we sell, we always credit the inventory account because it is reducing the inventory, since it is a reduction in an asset. Sales can be cash or credit. For credit sales, we have to recognize and account for the data in our records. Accounting for the buying of inventory. You buy cash means debit inventory and credit bank because you are spending. Buy on credit, debit inventory and credit creditors because you are not paying cash, you are buying on credit. Note that in both cases, the inventory account is debited. Accounting for the return of inventory, which is sometimes called returns outwards. We are returning our inventory outwards, therefore we are reducing our inventory. We therefore have to debit the bank account if we are returning and getting our cash immediately, and then credit inventory. But then if you are returning and the transaction was a credit transaction before, then you debit the creditors because it is reducing your credit or your debt, and credit inventory again. In both cases, inventory account is credited. Accounting for the sale of inventory. Selling inventory increases sales and either bank or debtors. This one you should always remember. Returns on sales or returns inwards decrease the assets and the cash or debtors. The corresponding debit or credit leg of the sales is the cost of sales account. And the cost of sale account is a debit transaction on the perpetual inventory system. In terms of sales price, sell inventory cash, meaning that you are debiting the bank account. If you sell on credit, selling inventory on credit means you're creating a debtor Therefore, you debit the debtors account and credit the sales account. In terms of cost price, when you sell inventory cash, you are reducing inventory. Therefore, you credit inventory and debit cost of sales. When you sell on credit, you debit cost of sales and also credit inventory account. Sales returns or returns inwards. These are like the opposite of sales. It is the reverse entry of the cost of sales at selling price. Sales decrease. The same will happen with inventory because it comes back to the business. Cost of sales will also have to be reversed. Accounting for the sales returns on perpetual inventory system goes as follows. The debtor returns the good, so in terms of the selling price, we debit sales account and credit debtors. In terms of cost price, we debit the inventory account and credit the cost of sales. Let's see the example 2.3 on perpetual inventory system. Using the perpetual inventory system, determine the effect of these transactions on the accounting equation. 1. Buying inventory for cash. 2. Buy inventory on credit from X company for $2,500. 3. Sell inventory cash for $450, cost price $300. 4. Sell inventory on credit to company Z for $700, cost price $550. 5. We return inventory from X company to the value of $180. 6. Company Z returns $500 worth of sales with a cost of $350. The answer for 2.3 goes as follows. Number 1. Buying inventory for cash, $600. This increases the asset inventory and reduces the asset cash. So those two transactions of $600 are under asset. You debit the inventory account and then credit cash of $600. Number 2, buying inventory on credit from X company for $250. It means you are increasing asset inventory and also increasing creditor company X by $250. You debit inventory and credit creditor. Sell inventory cash for $50 at cost price of $300. This increases the equity and cash by $450 because when you sell, you are increasing your profit, you are increasing your income. Then it decreases the inventory and equity by $300. You debit cash for $50 and sales for $50 credit. Then in terms of the cost, we are going to debit cost of sales and credit inventory with $300. 4. Sell inventory on credit to company Z for $700, cost price $550. Increases equity and data by $700 and then decreases equity and inventory by $550. On the selling side, you debit debtors and credit sales. In terms of cost, you are going to debit cost of sales account and debit inventory by the same amount of $550. 5. We return inventory to X company to the value of $180. This decreases inventory and creditor X. You debit creditor's account with $180 and credit inventory with $180. 6. Z company returns $500 worth of sales with a cost of 350. This decreases the equity and bank by 500. And then it also increases inventory and decrease debtors. Whereas the 350 is in the same category of debtors. When the sales are returned, it reduces the sales and therefore you debit the sales account or returns inwards and credit debtors account because the debtor has gone down. Then on the cost side, you debit inventory account with 350 and credit cost of sales with 350. The answer is summarized in the table below. If you find time, you go back to the question and see how the transactions have been put into the table that we see now. Note: transaction number 6 is exactly the opposite of transaction number 4. Transaction number 5 is exactly the opposite of transaction number 2. We are going to end with some practice questions which you are going to do on your own, which are as follows. Indicate how the following transactions affect equity, assets, and liabilities. March 1st, owner deposits $20,000 in the business bank account. On the 2nd, purchases office equipment from company A for $4,000 on credit. March 3rd, purchases a vehicle and pays cash $13,000. 4th, owner withdraws $300 for personal use. 5th, sells one of his vehicles on credit to company B for $1,250. March 6th, obtains a long-term loan from the bank for $10,000. 7th, company B pays its debt of $1,250. 8th, pays debt of $4,000 to company A. Question 2.2. Indicate how the following income and expense transactions affect the accounting equation. March 1. Buy cleaning material from company P on credit for $1,000. March 2nd. Pay allowance to personnel $6,000. 3rd. Receive $50,000 from Chu for services rendered. 4th. Pay electricity bill of $4,000. 5. Receive interest on investment from E of $8,000. Question 2.3. Using the perpetual inventory system, determine the effect of these transactions on the accounting equation. 1. Buy inventory for cash, $1,800. Buy inventory on credit from R company for $1,250. Sell inventory for cash of $1,450, cost price $1,100. Sell inventory on credit to S company for $1,700, cost price $1,350. 5. We return inventory to R company to the value of $880. 6. S company returns $1,500 worth of sales with a cost of $1,050. Those are the questions that you need to practice during your own time and come up with answers. Accounting and leadership. As already mentioned in the previous lesson, knowledge of accounting alone is not a solution to most of the challenges we encounter. At an individual or business level, there are solutions that accounting addresses by itself. However, at a macro level, that is, country, continent, and global arena, leadership plays a very important role in ensuring that the accounting principles carry a meaningful contribution to society. Politics, as part of leadership, can make or break the efforts that accounting aims to address, especially to make the business successful. Some of the challenges that have continued bedeviling the world, especially Africa, are the never-ending conflicts within the continent, foreign aggression, disunity within the continent, currency convertibility, and many more. You may have whatever qualification, but any of the above may hinder us from exercising the skills obtained in entrepreneurship. Therefore, all participants in the accounting environment should understand and embrace this fact and fully contribute to resolving such problems if entrepreneurship is to be successful. In conclusion, the following have been expanded on: further understanding of the double entry principle, various applications of the accounting equation, identification of the different types of business transactions and relating them to the accounting equation, understanding the perpetual inventory system. Relevant examples of each of the above have been given to show how accounting applies in our day-to-day lives. Practice questions have been given to enable everyone to follow the program. The lecture ends with a call to all participants to engage in leadership in order to make accounting at all levels more meaningful and beneficial to society. This marks the end of our session. Please don't forget to subscribe, give the lecture a like, and give your comments below so that we can make our sessions more meaningful and more beneficial to everyone. Thank you very much. God bless you.